Imagine this. You spend £50 today, and 4 weeks later, you walk away with £500. That's not a lottery ticket, that's a call option. Right now in the UK, everyday investors are using this exact strategy on stocks, indices, and ETFs to generate asymmetric returns. You're not gambling your life savings. You're making a small, calculated bet with a defined maximum loss. Over the next 12 minutes, I'm going to demystify call options completely, using simple language, real numbers, and a step-by-step plan you can actually follow. Stay locked in, because this one could genuinely change how you think about money. Let's start from zero. A call option is simply the right, but not the obligation, to buy an asset at a fixed price, before a set date. That's it. You're not buying the asset itself. You're buying the right to buy it later. Think of it like placing a reservation at a restaurant that's getting popular. You lock in your table price today. If the restaurant blows up and tables are now twice the price, your reservation is suddenly worth a fortune. If it flops, you just lose your deposit. That's your maximum loss. Simple, clean, and surprisingly powerful. Let me show you the mechanics. Every call option has exactly 3 things you need to understand. First, the strike price. That's the price you've agreed to buy the asset at. Second, the expiry date, the deadline by which you must act or the option expires worthless. Third, the premium, the price you pay upfront just to own this option. Let's use a real example. Suppose Rolls-Royce shares are trading at £4 today. You buy a call option with a strike price of £4.20, expiring in 30 days, for a premium of 10p per share. You control 500 shares for just £50. That's the leverage magic happening right there. Now, where can you actually do this in the UK? Great question. Not every platform offers options trading, so let's be specific. Interactive Brokers is the gold standard for serious options traders, competitive fees and access to UK, US, and European markets. IG Group is another solid UK regulated option with an intuitive interface for beginners. CMC Markets also offers options products with decent educational resources. For US stocks like Apple or Tesla, many UK investors access options through these platforms under their ISA adjacent accounts or standard dealing accounts. Always confirm FCA regulation before depositing a single penny. Your capital protection starts with choosing the right platform. Not all stocks are created equal for options trading. You want stocks with high liquidity, meaning lots of traders buying and selling options on them, which keeps the bid-ask spread tight. In the UK, FTSE 100 giants like BP, HSBC, and Barclays have decent options liquidity. On US markets accessible to UK investors, Apple, Amazon, and Nvidia have some of the tightest spreads in the world. You also want a stock that has a clear catalyst coming, an earnings report, a product launch, a regulatory decision. Buying a call option before a major catalyst is how you stack probabilities in your favor. Catalyst plus liquidity equals smart setup. Let's clear up 2 terms you'll hear constantly. In the money and out of the money. An option is in the money when the current share price is already above your strike price. So if you have a call option with a £4.20 strike and shares are at £4.50, you're in the money. There's already intrinsic value baked in. Out of the money means the share price hasn't reached your strike yet. In our Rolls-Royce example, at £4, a £4.20 strike call is out of the money. Out of the money options are cheaper, hence that 10p premium, but they require the stock to move. High risk, higher reward. Know which one you're buying. Here's the thing nobody warns beginners about enough. time decay, also called theta. Every single day that passes, your option loses a tiny bit of value, even if the stock price doesn't move. Why? Because the window of opportunity is shrinking. A 30-day option with a £50 premium might lose £2 to £3 of value every day just from time passing. This means if you buy an option and the stock goes sideways for 2 weeks, you could be sitting on a loss even though the stock hasn't fallen. The lesson? Don't buy options with no catalyst in sight. Buy with purpose, time your entry well, and never hold a dying option hoping it'll recover. Let me walk you through a complete real-world trade. It's January. You believe BP will rise ahead of its earnings report in February. BP shares are at £5.10. You buy a call option with a £5.30 strike price, expiring in 45 days, for a premium of 15p per share. You buy one contract covering 100 shares, total cost, £15. BP reports strong profits. Shares jump to £5.80. Your option is now worth at least 50p per share. The £5.30 strike versus £5.80 current price. You sell the option for £50. Your profit, £35 on a £15 investment, a 233% return in under 6 weeks. That's the options game played cleanly. Risk management is everything. Here's the rule I give any beginner. Never risk more than 2% of your total investing capital on a single options trade. If you have a £2,000 investing pot, your maximum single options trade is £40. That feels small, but it means you can take 50 losing trades before you're wiped out, while one big winner at 500% more than makes up for multiple losses. Also, never trade options with money you can't afford to lose completely. Options can go to zero. That's the deal. Use them as a small, speculative slice of a broader, diversified portfolio, not as your entire strategy. Discipline separates profitable traders from broken ones. Quick but crucial. Tax. In the UK, profits from options trading are generally subject to capital gains tax, not income tax. For the 2025 tax year, your CGT annual exempt amount is £3,000. So if your total options profits in a year stay under £3,000, you may owe nothing. Above that, basic rate taxpayers pay 18% on gains, and higher rate taxpayers pay 24% on gains for financial assets. Keep meticulous records of every trade, entry price, exit price, dates, and profit or loss. Your trading platform should provide a downloadable statement. Always consult a qualified UK tax advisor for your specific situation. Getting the tax right protects your gains. Let's save you from the classic mistakes. Mistake 1. Buying very short-dated options, anything under 14 days, as a beginner. Time decay eats them alive. Stick to 30 to 60-day expiries when you're learning. Mistake 2. Going too far out of the money chasing cheap premiums. That 2p option looks attractive, but the stock needs to move massively for it to pay off. Stay within 5 to 10% of the current share price. Mistake 3. Not having an exit plan. Decide before you buy. At what profit will I sell? And at what loss will I cut? Write it down. Follow it. Emotion is the enemy of every profitable trader. Eliminate it with rules. Before you put a single real pound at risk, paper trade. Paper trading means simulating real options trades without actual money. Interactive Brokers has a free paper trading account you can activate in minutes. Spend 30 days paper trading your strategy. Pick your stocks, identify your catalyst, buy the call option on paper, track it daily, and sell it, all without risking capital. Treat it exactly like real money. Track your wins and losses in a spreadsheet. After 30 days, analyze your results. If you've made consistent gains, graduate to real trading starting with tiny positions, £15 to £20 per trade. Confidence built on evidence beats confidence built on hope every single time. Once you've proved your edge through paper trading and then small real trades, scaling becomes a process, not a leap of faith. Here's a simple framework. Start with 1% of your pot per trade. After 10 profitable trades in a row, increase to 1.5%. After another 10, go to 2%. Never skip steps. If you have a losing streak of 3 or more, scale back down. Your goal in the first 6 months isn't to get rich, it's to learn the skill without destroying your capital. The traders making £2,000 a month from options didn't start there. They started with £15 trades, learned the patterns, sharpened the strategy, and scaled with discipline. That's the real path. Here's your 7-day action plan starting today. Day 1. Open a paper trading account on Interactive Brokers. Day 2. Research 3 FTSE E100 or S&P 500 stocks with upcoming earnings. Day 3. Identify a call option on each 30 to 45-day expiry. Strike within 5% of current price. Day 4. Paper buy one of them and begin tracking daily. Day 5 to 7. Study your options price movements and note what drives it. By day 7, you'll understand more about options than 90% of people who claim to invest. If this episode added value, smash that like button, subscribe to Mind Your Pounds, and drop your biggest money goal in the comments. I'll see you in the next one.